To start, I'm going to use this list of questions here. Now you can see the questions attached, or you may already have it, and even though they are not necessarily the questions that you're going to face on a day-to-day basis, they cover most of the key areas that you will need to understand in order to manage a business and to understand the finance relation to it. The first area I'm going to start with is the initial investment that you must make into the company. Here we can see the question 1 here. It's the owners invest $3.5 million into X hotel to set up operations. I've done this on the basis of a hotel industry as opposed to a manufacturing industry or anything like that, because the accounting systems are going to be slightly different, but the methodologies are still fundamentally the same. So the 350,000 into a bank account of X hotel to set up operations. The thinking behind this, obviously, if you've invested money into a business, into the bank account of a business, that means that the money has been lodged into the bank account. Your bank account has got additional funds. The money that was originally invested, of course, is still owed to the owners. So any money that's invested in the company is seen as money that the owners will be getting back at some point in the future, hopefully. So the business has to consider this to be a debt. Even if there is only one owner to the business owes that one person the money. So we need to account for that in the right place. Now, because it is the money the owners invested, we will just simply set up an account, calling it the money the owners invest. Now, this is called equity. It's part of, say, capital that will be paid back at some point, and by extension, therefore, we've got to put it in as a debt. This is where understanding, say, T accounts or debits and credits is important. Now, I'm not going to get into debits and credits because it overcomplicates things, especially when you're not necessarily going to be going into a huge amount of detail with these. You're literally doing this for bookkeeping. So what we have is we have the account. In the spreadsheet that I've given you, you can see that for each T account, it has a total. Now, the idea of putting the total into these T accounts is that then, that is the side that you know we are going to see any increases. Conversely, on the side where there is no total, you're going to see the decreases. So after you're going to add up all of the increases, subtract all the decreases, like that gives you the total, such as you will see in your bank statement. So that's literally what we're going to do here. We said that the owners are going to make an investment in the bank account of $3.5 million. And we need to account for that in the account that's going to say that we're going to have to pay this back. Now, I've created an account. Now, all you need to do is find it. That it's called, say, the owner's investment, or sorry, that is part of the capital. Now, owner's investment here. It's part of capital. It's in the spreadsheet. Now, you can see in this case here, I just have the number as opposed to the symbols of the account. I can put them in. It doesn't make a huge difference, but it's always handy to have it. So we then know that any increase goes on this side of the account. Because we have invested the money, that means we now need at some point to pay this back. So we've increased the owner's investment. Remember, we're talking about increases and decreases. Do not confuse this with positive and negative. Do you consider the owner's investment to be a positive thing? Well, maybe you do. Maybe the fact you need an owner's money, you consider it to be negative. So it's increases or decreases. That's all you are concerned about. In this case, it is an increase of $3.5 million in the money that we are going to need to pay the owners at some point in the future. Label it as you want. I mean, whether you call it investment. In this case, I don't necessarily need to, but that is basically the first transaction. Key thing with all of this is that you will find, forgetting debits and credits completely, I'm not going to refer to them at all. I mean, you can see the video relating to that. But when you're talking about the T accounts, the reason they were designed this way is because they were originally done in hand to make sure that there was no confusion. When you have 3.5 million on the left hand side and 3.5 million on the right hand side, then you know it balances. Every transaction balances. The reason why we do it twice is that there is a situation that has occurred, which is the fact that you've invested the money, and there is the consequence that it is going to have on the cash or the money in the bank, and this is what we're doing. So in every situation you're going to have two transactions, one for the event and one for how it affects the cash, and they will mean, it means that both sides must balance. When you're doing every transaction for your own accounts or for these exercises, you must make sure that when you're finished you have put the same amount on each side.